I'm Ted Seides, and this is Private Equity Deals. This show is an exploration of deals in the private markets. Through conversations with private equity managers, we'll dive into individual deals to learn about deal dynamics, companies, and ownership that make private equity a force in institutional portfolios and the global economy. Season 1 of Private Equity Deals focused on owners you know. Season 2 focuses on companies you know. You can keep up to date and join our mailing list at capitalallocators.com.
All opinions expressed by Ted and podcast guests are solely their own opinion and do not reflect the opinions of capital allocators or their respective firms. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Past performance is not indicative of future results. Clients of capital allocators or guests may maintain positions in securities or managers discussed on this podcast.
On the final episode of Season 2 of Private Equity Deals, Andreas Holzmueller and Luke Chapman discuss Partners Group's investment in Breitling. Andreas and Luke represent Partners Group, an investment firm that canvasses buyouts, real estate, infrastructure, and private credit with $130 billion under management, $70 billion of which is in private equity. Breitling is one of the leading Swiss watchmakers, founded in 1884 as a pioneer in aviation-focused technology, and which today is positioned as a casual, inclusive, and sustainable luxury brand. Our conversation covers Partners Group's thematic approach, Breitling's long history, and its characteristics as a luxury brand business. We discuss Partners' initial purchase of a minority stake in the business, its path to buying a controlling stake, and plans to grow the business from here. Please enjoy my conversation with Andreas Holzmueller and Luke Chapman. Andreas, Luke, thanks so much for joining me.
Thank you. Happy to be here.
Why don't we start with just a little background on Partners? And Andreas, why don't you kick it off?
Happy to. So Partners Group is an independent investment firm dedicated to private markets. So that's private equity, real estate, infrastructure, and debt. We have our roots in Switzerland, where the firm was founded in 1996, and this is also where we're listed today, but we're very much a global business today with 2 headquarters, one in Denver, Colorado, and one in Zug, Switzerland. And while a lot of our history is in Europe, today the majority of our investment activity actually is in the Americas. Over the last decade, we have invested most of our firm's capital in the US market. Across the global business, we manage around $130 billion of assets under management. 70 billion of that is roughly in private equity. When it comes to investing, we see ourselves as long-term business builders who create outcomes that are beneficial for all stakeholders of a company. And that is based on 2 pillars. It's thematic investing and it's entrepreneurial governance. Thematic investing refers to the fact how we find companies. And this is about identifying pockets of strong secular growth and then doing real in-depth research on these market niches over years with a disproportionate amount of resources, teams working only on these themes, building networks with executives, with advisors. And this is a process that can go on for years until we ultimately make an investment. But it's very much about understanding the environment you're investing in detail. When we own a company, end up successfully acquiring one, it's very much about creating entrepreneurial behavior at scale. It's about accountability at the board level, a strong sense of direction and strategy setting by the board in collaboration with management. We're not a firm that tries to find market inefficiencies and make a nice return through that. We really want to create long-term strategic change, build better businesses, and act as long-term owners with an industrial mindset.
Great. Well, let's turn to Breitling. It's a brand that's well known. Luke, how would you describe this company?
I'm hopeful that people know the brand that are listening to this audience. It's a well-known brand globally in luxury goods. So very simply, it makes Swiss watches. It sells watches on an average between US dollar 5,000 to 10,000, which is clearly a luxury price point. So it's a luxury good. It is slightly less than some of the very ultra-luxury brands in the industry, Rolex, Patek, and Audemars. The company, as with many in the luxury goods sector, has a very rich history. So it dates back to the 1800s. It was actually really a single product company making tools for pilots, and ultimately became famous for a wrist chronograph, which is a fancy way of saying stopwatch. But it's essentially a product that pilots could wear on their wrist and could really perform all calculations that they need to do in the cockpit. Average speed, distance, fuel, rate of climb. This was quite a technical innovation at the time. Obviously, since then, the early 1900s, it's evolved into a product about beauty and design, but it's really retained that utility and that DNA as its heritage. The company has had 4 owners in its history. So for a very old company, that's somewhat unusual, really. The first was the Breitling family, and Willy Breitling, who's probably really was responsible for many of the iconic designs of the company in the 40s and the 50s. During the quartz crisis in the 70s, which was a very dramatic time for the watch industry, he sold it to a private entrepreneur, a real aviation enthusiast. And then in 2017, it was first acquired by a European private equity firm, CVC. And then in 21, we first, as Partners Group, made a minority investment, and then just before Christmas, made a controlling investment in the company.
Andreas, as you talked about the thematic nature of your investment approach, how did Breitling fit into your themes and looking at the world?
So we have a theme that we call neo-luxury, which is focused on investing behind a new kind of luxury consumer, a younger, more casual profile than what traditional luxury brands cater to. Neo-luxury consumers are more digitally engaged and have spending habits that are more connected to their values, particularly sustainable living. In the end, it's about affluent people who get more joy from surfing or cycling than driving a luxury car. And we see very strong growth in that segment and a bit of fundamental shift in the luxury consumer. And Breitling, with its heritage and its positioning, is uniquely positioned to address this consumer.
How did you go about sourcing the transaction?
We've identified it through our thematic work as a highly, highly attractive investment opportunity. We engaged in a dialogue with the shareholders, with the company's management. There's also a strong relationship between our company's founder, Freddie Gantner, and the CEO, George Kern. So we had that dialogue for some time, but it took years for a transaction to materialize. And then it was first this minority transaction where CVC had decided to sell a minority stake in the business. We had all the time tried to actually buy more and acquire a majority, but that was the only way to get involved. So we participated in that minority process, ultimately ended up winning it.
So you knew you were interested for years. CVC decides to sell a piece. What happened in that deal process?
We obviously came at it with a very high degree of conviction, also in the long-term growth of the business. And through that, I think had a great advantage compared to other more opportunistic investors. Because it was a challenging time, the company had just come out of COVID. There was a lot of noise in the numbers with regards to closed markets, closed stores, and then the bounce back. And what's really your sustainable revenue base? And through the long-term work that we had been doing, we were able to get comfort around that and ultimately pay the winning valuation.
What was that diligence process like, both over the years and getting comfortable with the theme and then in that acute period of time?
The 21 diligence for the original investment obviously was backed by a lot of industry work up front. But we still had a lot of questions. And as Andreas mentioned, this was a challenging time to underwrite and to really understand and unpick what was driving growth. As a firm, we over-index typically on industry expertise rather than management consultants. We did a big survey of luxury consumers and talked to wholesale dealers in the industry. And really, we're trying to understand why a consumer is buying Breitling. That was the main topic that you're trying to get a sense of as to how sustainable and how long-term this growth path. What is the quality of the growth? That really is what we were training in on. Ultimately, the findings of that were very clear that there was a consumer that was finding that this product suddenly resonated with them and the brand message suddenly resonated. So this was something we focused on, the primary evidence, but surrounding ourselves with opinions of people in this industry, you probably won't be surprised. The industry has quite a lot of opinion shapers. A lot of people are passionate about watches. So you have the real promoters, you have a lot of detractors who will say that there isn't a path for this brand. So as an investor, we had to be as evidence-based and as structured as we could to say, what is this brand? Why is it winning? And ultimately, we convinced ourselves that there was a very exciting path for this brand to go on.
As you modeled that out, what did you see as that big opportunity?
So there are a couple of big levers. What had been going on in the business was a complete overhaul of product and brand. And I'll start with brand because that's actually probably the hardest work you can do in a consumer product company is completely reshape your brand message. And that is what had to be done with Breitling. When George Kern joined the business, he had to shift from what was very macho, very aviation and automotive focused to position it much more broadly to a set of consumers who maybe weren't aviation enthusiastic, but still had an interest in this brand. And so what that brand reshaping was all about tailoring the product and the brand message to this very attractive luxury consumer base that we had all identified that we wanted to address.
How did that actually work, that ability to change the perception of the brand?
So there are some very simple things that happen. You will probably know Breitling for its wing-shaped logo. The wings were taken away. That was one big step, which was not uncontroversial to do to a brand with this kind of history. The second, and one that is actually very powerful, is the boutique design. And boutiques are the retail stores. That's where a Breitling-owned branded store, the concept of the store was this industrial loft feel, which has a very different look and feel to actually most of the industry. The watch industry really sells a lot like a jewelry business. You go in and there's someone with white gloves. When you go into a Breitling store, it's often exposed brick. It's got mezzanine with a bar to serve you a drink. It might have a surfboard and a motorcycle in the store. So it's really about storytelling and brand communication in store as part of that experience to reshape that brand communication.
And it's also about storytelling in images and in the actual stories that you tell. The imagery was completely changed from this male aviation theme to this what we call squad concept, which is casual. It's about interesting personalities that have inspiring life story, such as, for example, Giannis, the basketball player, and others of our brand ambassadors that we engage with. And this is, I feel, a unique strength of this team. George Kern, the CEO, and his team, how they tell the story of the brand with its long history and heritage and put that in a modern context. That is just outstanding.
What did you see as some of the issues or potential risks with the deal?
One of the biggest topics for this industry has been the smartwatch category. And so that was really, for us as a team, for our investment committee, getting comfortable that this was an enduring category, despite what was going on with the Apple Watch, was a really big topic, particularly before we first invested. I guess give some context. Prior to 2015, the Apple Watch didn't exist. And today they sell 80 million units of smartwatches. Now, the Swiss watch industry this year sold 16 million units. So you have now a market which in a very short period of time had completely changed the watch landscape. For us in 21 and continuing with the majority investment to understand what role that plays in the mindset of a consumer of a luxury watch was very important. So we spent a lot of time on this topic. We surveyed our consumers, like I'd already mentioned. And actually what we found is that amongst luxury watch communities in this price category of above $5,000, this is actually a very complementary product. So for the most part, people owning a luxury watch really also own a smartwatch. One has utility and one is something design and beautiful that represents their personality and is something a lot more formal in certain respects. It's more of a piece of jewelry. That's something that we really took a lot of time to get our head around and to convince ourselves that this wasn't going to be a market disruption.
What are the economics of the business?
In the luxury industry, I think it's very common to have margins, EBITDA margins between 20 and 30%. That's also the area that we play in here. That reflects the pricing power. It reflects desirability of the brand and also the product. which allows you to have this setup. It's also a very attractive category for the retail channel. It's also something that is important to us as Breitling, being fair partners to our retail partners and also allowing them to grow.
So you mentioned that the business fits right into your sweet spot. There's an area you knew you wanted exposure to. It's almost like you have an axe for this type of transaction. And luxury goods companies tend to trade at pretty rich prices in the public markets. Curious, when you won the deal for the first time, to what extent was that just a price competition relative to others that you had conviction paying up?
It's both, right? We convinced owners and our today's partners, CVC, that we could be a good and relevant partner and actually add value in the periods to come. We convinced the management team under George Cairn that we could be a good partner and they wanted to work with us. But ultimately, we also needed to pay a market price in order to come out as the winning bidder. And clearly, business that is as fast growing as this business, as strong of a customer proposition, has a certain price.
So what happened in that first year from when you bought that initial minority stake to the majority stake just a year later? At least it was reported the valuation was up almost 50%. What happened in that first year to allow you to have conviction to do that?
When we came in, we were genuinely surprised with what we found. The quality of the strategic agenda, the pace at which this company works and implements things is truly outstanding. And this is very much, again, down to the management team. These are just nimble, fast, smart people that make things happen. If you look at your average watch group, it's big headquarters, huge structures. And these people, they're just different. They operate with small budgets. They tell powerful stories and find a way to make that known to the public. And that really impressed us, much more than the figures, which were obviously good and supporting the case and much better than we thought.
So typically when you think about a private equity transaction, you think about very transparent, almost perfect information when you're going in. In all the work you had done on the industry and knowing the company, what was it that was a surprise?
You obviously always try to take a critical view when you buy something and when you're doing due diligence. And one thing is the plan that you're being presented. And the other thing is what's really the granularity that is behind it. And this is what we didn't see before we were co-owners of the business. Really, the store rollout plan in detail, the watch collection planning, the launch planning, the designs.
I think that's the detail, and the CFO comes out of the aerospace industry. The way that this plan had been built up, by line item, by watch sold, it was very, very impressive. And that's the thing that outside in, it's very hard to assess. And I think that's where we describe this first 12 months of being in the business as a very unique inside out diligence process. It really was. I wish every time we were going to take controlling stake in a company, we could have spent 12 months with the team in advance. It's really a unique situation that we found ourselves in. And I think could have clearly gone both ways. It could have ended up with more negative surprises. I think what we ultimately found is that the credibility of what we thought we'd find, and we certainly outside in had convinced ourselves of, we actually found was there in spades, and it was very impressive.
So when you're involved in a team that's operating at such a high level, how do you think about what your role is as the owner going forward?
Our role is very much to drive strategy and to drive the long-term transformation of the business. This is how our boards work. With a strong chair, we call that the lead operating director. In this case, it'll be Freddie Gantner, co-founder of our company, complemented with certain independent directors with specific expertise. And in that group, really, together with the management team, define the must-win battles for the next 5 to 8 years, develop an agenda of how we get there, and then just follow through with that and stay on course. This is really our purpose as investors, I feel.
How does your organization, across the organization, work with Breitling in different ways?
We have the board where we have 2 members of our group represented. We have a number of other functions that support the business, that work with Breitling. We have an ESG team that engages with Breitling on sustainability topics and other ESG topics. We have a capital markets team. We have operational and functional experts that work with the company. So there's really many, many points of contact that we have there.
So Andreas, you mentioned when you got involved for the first time, tremendous positive surprises in terms of the management's ability to execute. It's very rare that a deal goes through its life without some negative surprises or bumps in the road. And curious some of the things that you've seen that have been tricky for the business in your period of ownership.
We're only on this journey for now roughly 1.5 years. We've seen challenging retail environments. We've had, of course, in Asia, still the COVID restrictions for a long period of time, which obviously were difficult to deal with, also in terms of just planability and where to allocate product. I think we've had difficulties in actually supplying the required volumes in our manufacturing business. So I think these are probably the points that I would make here.
Prioritization as well. With a business, and we've talked about the team, very high energy, very ambitious. They would want to do 10 things at one time. I think deciding where to invest at the right time, in what stages, I think is also one of the things that clearly is you can never be sure that you get that right. And with Asia, as an example, you need to progress relatively conservatively reading the market environment.
So what is that game plan with Breitling today?
There's a number of things that we really felt when we were underwriting the majority transaction that we could do once we come in. And this, as we mentioned, was really a lot of what we had been talking about with management and had access to a lot of the planning. I think number one is actually around the brand. And we talked about this brand transformation, which was very powerful, but brand building and brand communication is not a 3-4 year exercise in an industry which has 150-year-old brands, and this being one of them. So you don't change the mindset of the consumer overnight. Continuing to emphasize a brand message that we have, which we know to be resonating because we have the evidence that the consumer likes it, but reaching more of that audience, we feel gives this brand a lot more runway to go. And remember, in this industry, people don't buy a watch 4 times a year. They're buying, it's an occasional purchase, an anniversary, a birthday, a special occasion. So the moment that someone comes back to the market to buy a Breitling, they might not have experienced Breitling for 10 years. And actually, the message now is quite different. Andreas mentioned the storytelling that we still have to go. That also takes time. We have this collaboration, a new product which we launched last year with Kelly Slater, which has a very interesting backstory. I mean, his father used to wear an orange watch and lost it surfing. And so Kelly designed with the Breitling team a new watch, and there's actually still very few people that have heard that story. We need to find a way to push that communication out and also to new markets where the brand just is still underpenetrated. One topic is actually the US market, where we find that to be a market which, number one, is fundamentally very attractive. And from a luxury watch industry perspective, underpenetrated. The US consumer, despite having 5 times the population of the UK, spends really only 20% of what the UK consumer is spending on watches. So the penetration game in watches in the US market is actually very substantial and an opportunity that this brand will go after by reaching more consumers. I think one of the other big areas for us is balancing out the gender mix of the brand. The brand has been a very male-centric focus, not surprising given its aviation history, but that is something that will change. And that has been changing under George, launching dedicated lines, having dedicated female ambassadors, and a more thoughtful retail concept. And then probably the last thing I touch on is the e-commerce and digital. And that's something that this industry has been relatively slow to move around e-commerce. There's actually many brands that still don't transact online and don't communicate very much digitally. And Breitling has really been innovative in this area, not only around the transactional side, but also we have blockchain-enabled watch certificates and warranties, and have been one of the first brands to do that. Part of that is also about addressing the secondary market, which is a very big market for this category. For us, despite CVC having already invested for some years, there's actually many levers for us to really grow the business over the coming years, and something that we're excited about.
So each of those levers you described, penetration, gender balance, e-commerce, all part of the revenue volume story, increasing volumes. Curious how you think about price in a competitive market. You mentioned smartwatches at a lower price, Rolex type higher end pricing. How do you think about pricing of the different Breitling products?
We are a generalist brand. So we have a watch for everyone and for every purpose in the luxury watch industry. There's a sports watch at the entry segment. There's very, very nice dress watches with extremely complicated movements at the upper end of the spectrum. And our ambition really is to be an inclusive brand that has an offering for everyone. And that's also how we think about price. We clearly, over time, want to further use the strong heritage and watchmaking capabilities of the brand by introducing further complications to our movements, and through that, create nice watches that people want to buy.
Have you thought about the cost structure of the business?
The goods industry is obviously a high margin business. You have companies that easily achieve mid-30s, high 30s EBITDA margins. Breitling is not there today, but it certainly gives you comfort that as you continue to scale the business globally and generating scale in markets where today and parts of Asia are a good example where Breitling still is very small relative to some of its peers, we'll have an opportunity to improve margins over time. The cost base is very variable. You have a large proportion of your OPEX, which is marketing, which is the right thing to do for a growing brand, but also is something that can be flexed as you need it. Whilst we have a large retail footprint, we have 200 stores globally. We don't own and operate all of our stores. We operate in concert with wholesale partners who also manage our retail on our behalf. So that gives us a more variable nature in our cost structure, which also helps.
What's the historical cyclicality of the business?
The luxury industry has proven to be actually very resilient through many different economic cycles. It's one of the things as we think about investing in the industry that we like about it. And why is that? Ultimately, we're not addressing a broad cross-section of the consumer here. We're addressing actually a very narrow segment of households who are spending on average above $5,000 on a watch. The reasons for that consumer making that purchase decision are not uncorrelated, but certainly less correlated to the macroeconomic environment. The watch industry, from a consumption point of view, has been relatively cyclical at points in time, but I would say in that 5-6% decline in a difficult year, but that's in a severe recession. So that's something when you compare across different end market segments, actually compares quite favorably.
So when you thought through the high profitability of the business, that less cyclicality than other industries, how did that translate into how you thought about financing the business?
Actually, the leverage, it remains quite conservative in the business. That's twofold. I think one, it's not really a part of our strategy to use very high leverage. So in the 4 times leverage is where we're more comfortable. And then I guess for the second reason is in a more uncertain environment, we certainly didn't want to, with rising rates, certainly feel that we were overburdening the company with leverage.
This is really about growth. And we need to have the flexibility in the company and the funds to invest in growth.
With only 4 owners in the long history of this business, how do you think about your likely duration of ownership of the company?
As usual, you make a plan in private equity that is 5 to 8 years, very much committed to this company and don't see ourselves exiting anytime soon. We're very much focused on driving this strategic agenda, and it'll take however long it takes to get there.
Where do you have your antenna up of risks on the horizon?
It's very much around just the macro environment, where the world is going, disruptions in different places in the world, and being able to react to those in a fast way. And clearly there's many things going on at the same time, which have implications for our trading environment, for how we operate our stores. I think we're quite sensitive to that.
How do you advise the management team to prepare for those types of shocks?
It really is about scenario planning, which again is something that they're doing very, very well. But you just need to have a few plans in your drawer and you pull out the one that you then ultimately need. And it's about flexibility, which is what Luke pointed out. It's about adjusting costs in that place of the business, increasing marketing in another geography, moving around. It's about allocating product quantities where they're needed. It's about scenario planning, speed, and adaptability.
What have been your biggest lessons learned from this transaction?
I think for me, it's been about finding a way to rationalize and build conviction in a brand like this when you've got many strong opinions. This industry, there's many people enthusiastic about watches and have a view on different brands. And so we really had to try and distill all of that information, the view from the channel, the view of the consumer, and come to an investment decision. In that process, assessing that you may actually not be right on some of these points. That's the nature of also investing in brands, that the range of outcomes is actually broader than in certain other sectors. But I guess if on balance you feel that there's fewer ways to be wrong than there are to be right, then you probably are making the right investment decision. And I think that's for us was really that process of making sure that we're reading the right evidence and objectively making a good decision.
I have one last question for you both, which is, what is your favorite aspect of private equity?
It's the entrepreneurial element of it. It's about finding a market with structural growth. It's about finding the right company to play in that market, acquiring it, and then making it perfect with the resources of a global financial institution. This is what really, truly excites me.
Luke?
For me, I think is that we're actually never an expert, that we've got to filter from people who've spent their entire life in a particular niche and take that information and then make an investment decision off the back. You'll never have the feeling that you completely know the right decision. It's about processing information and coming to an outcome. It's a challenge that you face every day. It's exciting and challenging, but very rewarding.
Well, Luke, Andreas, thanks so much for sharing this story, and I'm wishing you all the best continued success with the growth of Breitling.
Thank you very much, Ted.
Thanks for listening to the show. If you like what you heard, hop on our website at capitalallocators.com, where you can access past shows, join our mailing list, and sign up for premium content. Have a good one, and see you next time.